Welcome back to Iron Financial, the only channel where we take corporate earnings reports, throw them directly on the anvil, and strike them with the sledgehammer of hard data. If you haven't already, make sure you hit that subscribe button right now to join the smartest retail investors out there forging stronger, more resilient portfolios. I'm your lead analyst, and today we are executing a brutal, entirely uncompromising structural stress test in this explainer of CarMax's Q1 Fiscal 2027 earnings report.
And I'm the market skeptic. Look, we all know Wall Street absolutely loves to build a shiny, beautiful facade out of carefully worded press releases and magical adjusted EBITDA numbers. Well, my job here is to strip away the drywall, look at the actual steel beams holding this company together, and find out if retail investors are buying into a genuinely solid structural asset or if they're stepping into a collapsing value trap. Today, we are putting CarMax under maximum heavy load. Let's see if it bends or if it breaks.
The core question we are answering today is absolutely critical for anyone holding or thinking of holding this stock. Is CarMax actually forging genuine growth in what we know is a very tough macro environment, or are we witnessing a slow-motion meltdown? The institutional money is looking incredibly closely at this Q1 print, and I've got to tell you the signals are deeply, deeply mixed.
Yeah, well, mixed is just a polite way of saying the blueprint doesn't match the building. Management is out there pitching this grand narrative of market share gains and brilliant strategic pivots. But when we start looking at the sheer friction in their day-to-day operational model, you have to ask yourself if this is a solid foundation for your money or just corporate spin masking immense structural strain. Let's get the torches out and cut right into these numbers.
All right, let's start this inspection right at the top. Section 1, the revenue versus profit paradox. Let's look at the hard data here. Net sales and operating revenues rose an impressive 6.2% to a staggering $8.013 billion. That is a massive top-line figure. I mean, in any retail environment, generating over $8 billion in a single 3-month quarter shows your primary engine is moving a tremendous amount of physical inventory. From an institutional perspective, getting top-line growth of over 6% in today's highly fragmented, highly competitive used car market, that is a serious display of industrial scale. They are successfully acquiring, processing, and selling an enormous amount of heavy metal.
Okay, I'm going to stop you right there, because that $8 billion figure, it's pure vanity if the internal mechanics of the business are grinding to a halt. Look at the contrasting reality right next to it. Net earnings absolutely plummeted by 11.8%, dropping all the way down to $185.6 million. Think about that for a second. They are moving way more metal, generating way more top-line revenue, but keeping significantly less of it. That is the exact definition of structural inefficiency. Why on earth are they working 6.2% harder just to make 11.8% less money? That tells me the cost of doing business, the everyday overhead, the friction in their system is just eating them alive from the inside out. When revenue goes up and net earnings drop by double digits, you have a massive structural leak, period.
Well, that operational friction flows directly down to the shareholders. Diluted earnings per share slipped to $1.31, which is down from $1.38 in the prior year quarter. You are seeing the bottom line strain quantify itself right here in real time. The sheer operational mechanics of this business, the cost to acquire that inventory at auction, transport it across the country, recondition it up to the famous CarMax standards, and finally sell these vehicles. All of that is putting a heavy, undeniable load on the profit margins. Simply put, it costs them more to generate that $8 billion in revenue than it used to.
It's exactly like running a blast furnace at absolute maximum capacity, burning through massive amounts of fuel, only to realize your operational costs are actually higher than the market price of the steel you're producing. The diluted EPS drop is the structural fatigue finally showing up in the blueprints. Management can boast about $8 billion in sales all day long to the financial press, but if the EPS is slipping, the retail shareholder is the one feeling the weight of the collapse. You don't buy top-line revenue, you buy earnings, and right now, the earnings are buckling under the pressure.
Let's transition to the actual movement of inventory. Section 2, the unit dynamics. Here is the split to help us really understand the throughput. Combined retail and wholesale units grew 3.3% to 392,357 vehicles. We are talking about nearly 400,000 vehicles processed, bought, and sold in a single quarter. It definitively proves that CarMax's omnichannel infrastructure and their vast national footprint are functioning at a highly elevated scale. The gross volume is expanding. They are, without a doubt, taking market share in aggregate terms.
But look at the fatal flaw right there in that exact same data. Comparable store used unit sales are actually down 0.8%. Let's be very, very clear about what this means for the retail investor. Comparable store sales are the absolute bedrock of any physical retail operation. If your comps are negative, your foundation is sinking. Full stop. Look, if you open 10 new physical lots, of course your total volume goes up. That's just basic math. But if your existing mature locations are actually selling fewer cars than they did exactly 1 year ago, you aren't growing organically at all. You are actively masking a decline with physical expansion. Growing total volume by slapping down new lots or aggressively pushing wholesale at auction doesn't fix the fact that the core retail footprint is structurally weakening. That negative 0.8% is a massive red flag for the health of the core business.
That brings us right to the root cause of this pressure. Section 3, cracks in the margins. Here is where the impact is quantified in dollars and cents. Retail used gross profit per unit dropped by $230, down to $2,177. Now, management explicitly states this is a direct reflection of deliberate pricing actions implemented to drive an improved sales trend and support overall volume. From a macroeconomic standpoint, this makes sense. They are sacrificing a bit of per-unit profitability to keep the inventory turning and maintain their market share during a period of serious consumer affordability constraints.
Oh, deliberate pricing actions? That is an absolutely incredible piece of corporate spin. Let me translate that into plain English for everyone watching. We couldn't sell our cars at the prices we actually wanted to, so we had to slash our margins just to get people to buy them. A $230 drop per unit, multiplied across hundreds of thousands of retail vehicles, is a massive, devastating hit to the structural integrity of their profitability. They are fundamentally trading their margin just to keep up the appearance of volume. They are essentially selling off pieces of the scaffolding to keep the building upright.
Well, management frames this within their 4-pillar growth strategy, which explicitly includes competitive pricing and maximizing value per transaction. They are attempting to engineer a high-velocity business model. By lowering the retail price, you inherently increase the speed of the inventory turn, and faster inventory turns minimize the very real risk of depreciation on the lot. If a car sits for 60 days, it loses value. If it sits for 30, it doesn't. So slashing the margin is a calculated, necessary weld to adapt to consumer affordability issues and persistently high interest rates. A necessary weld? It looks a whole lot more like a fatal structural flaw to me. If your supposed 4-pillar strategy fundamentally relies on gutting your own profitability just to maintain unit velocity, those pillars are totally hollow. They are heavily exposed right now. Vehicle acquisition costs at the wholesale level remain incredibly high, while the retail consumer on the other end is completely topped out by inflation and borrowing costs. CarMax is trapped right in the middle of this dynamic, and the retail margin is exactly what gets crushed in the vice. The aggregate numbers really tell the tale perfectly here. Total used vehicle gross profit was down 9.5% to $501.4 million. However, wholesale vehicle gross profit actually jumped 8.3% to $169.5 million. The wholesale division, which sells units at auction to other dealers, is acting as a much-needed stabilizing counterweight here. It's driven by higher wholesale unit volume and a very strong $400 higher average wholesale price per unit compared to the prior year.
The wholesale division is doing great, sure, I'll give them that. But look at the sheer scale difference between the two. The retail side lost almost 10% of its profit, dropping all the way down to $500 million. Meanwhile, wholesale, even with its impressive 8.3% jump, only brought in $169.5 million total. You simply cannot expect a $169 million wholesale segment to bear the immense weight of a collapsing $500 million retail segment. The math does not work. The wholesale side is fundamentally incapable of bracing the main structure against a 9.5% retail collapse. It's like putting a single wooden 2x4 under a collapsing steel beam. It might look nice for a second, but it's not going to hold the load.
Which forces us to take a hard look at the balance sheet. Section 4, Structural Strain and the Debt Load. On June 15, 2026, CarMax entered into a brand new term loan facility. This is a massive $500 million term loan injected directly into the business, maturing in June 2029. It's a direct financial obligation designed to optimize their capital stack and provide fixed-term, guaranteed liquidity over the next 3 years to weather any potential macroeconomic storms on the horizon. Optimize their capital stack? Come on, let's call it exactly what it is. They had to go to the credit markets to borrow $500 million just to manage their existing obligations. A term loan is hard debt. It comes with fixed, non-negotiable payments and strict financial covenants. Why does a company that claims to be generating $8 billion in quarterly revenue suddenly need a $500 million cash injection? It signals incredibly clearly that the internal cash flow from operations simply isn't sufficient to maintain their desired capital structure. The filing actually answers that directly. The proceeds of this new term loan facility were primarily used to pay down normal course borrowings under the company's massive $2.0 billion unsecured revolving credit facility. From an institutional viewpoint, this is a very standard Treasury maneuver to term out debt, moving from a short-term revolving line of credit that carries variable interest risk to a structured, much longer-term maturity. It gives them visibility and stability.
It's not a standard maneuver. It's a glaring warning sign, flashing red. Let's translate this into real-world terms. They're maxing out their corporate credit cards, the revolver, and having to take out a structured personal loan just to pay it off. They're literally just moving heavy, dangerous loads around a very weak floor. Taking on new, fixed-term debt to pay off old, short-term debt, especially while your net earnings are dropping 11.8%, is the corporate financial equivalent of robbing Peter to pay Paul. It absolutely does not strengthen the foundation. It merely delays the inevitable collapse of the structure.
We also have to objectively acknowledge the broader debt landscape to get the full picture. CarMax carries a truly massive $15.5 billion in non-recourse notes payable on the balance sheet. Now, it is absolutely vital to note that these are non-recourse, meaning they are tied directly to the auto loans held for investment, which are primarily funded through complex securitization transactions. It's essentially ring-fenced from the core corporate operational structure. If those underlying consumer loans go bad, the bondholders take the hit, not the parent company directly.
Ring-fenced or not, $15.5 billion is a staggering, unfathomable amount of weight bearing down on this entire operation. If the macro environment deteriorates further and consumer auto loan defaults spike, which is highly possible, that entire securitization machine grinds to a total halt. Suddenly, they can't package and sell those loans. Add in the $2 billion unsecured revolver they are heavily leaning on, and this brand new $500 million term loan, and you have a heavily leveraged entity trying to operate in a high interest rate environment with rapidly shrinking retail profit margins. The corporate foundation is absolutely groaning under this immense, multi-billion-dollar weight.
So let's look at how management is actually responding to this exact pressure. Section 5, Operational Overhead and CarMax Auto Finance.
The data here actually shows impressive operational leverage and true corporate discipline. Selling, general, and administrative expenses fell by 3.7%, down to $635.2 million. Even more importantly for the structural integrity of the business, SG&A per total unit improved by $118, or 6.8%, bringing the cost per unit down to $1,619. They actively reduced total compensation and benefits by $25 million in a single quarter. This is quantitative proof that the structural efficiencies and cost disciplines management promised are taking real hold.
Okay, I will concede that a 6.8% improvement in SG&A per unit is a solid operational weld. Dropping costs while simultaneously increasing total unit volume is very difficult to execute, so credit where credit is due. However, let's talk about the stark reality of that $25 million cut in compensation and benefits. When you cut that much in compensation, you are cutting people. You are cutting the very associates who are supposed to deliver that unrivaled customer experience that management constantly brags about in their 10K filings. You simply cannot slash frontline staff without eventually degrading the core consumer product.
This ties directly into their broader strategic mandate. Management has outlined a clear, incredibly aggressive exit rate target of $200 million in annualized operational savings by the end of fiscal 2027. They're aggressively recalibrating the entire business to run far leaner, heavily utilizing their digital capabilities and omni-channel platform to permanently reduce physical overhead and headcount. It's a modernization of the entire corporate structure.
Yeah, I've seen this exact same movie before with a dozen other leveraged retailers. A $200 million cost savings target isn't a strategy for robust future growth, it is a defensive crouch. When your retail margins are compressing by $230 a car and your EPS is dropping double digits, you have to promise Wall Street massive, eye-watering cost savings just to keep the stock from completely cratering. I demand to know if this is genuine, sustainable operational efficiency or just desperate, defensive cost slashing that will ultimately erode their competitive moat and damage their brand long-term.
Let's pivot and look at the financial engine powering a vast amount of this enterprise, CarMax Auto Finance, or CAF. This is a massive, vertically integrated earnings stream for the company. In Q1, CAF contributed a massive $140.2 million of pure income. Furthermore, their financing penetration rate, which is the percentage of all retail units financed internally by CAF, actually increased to 43.3%. They are capturing more and more of the value chain.
Financing 43% of your own sales is a huge structural advantage, absolutely.
But you have to realize it also means you are acting as both the auto dealership and the bank. It inherently doubles your risk profile. If the consumer is struggling to afford the car on the lot, they are also going to predictably struggle to pay the high-interest loan over the next 5 years. And while you eagerly highlight the $140.2 million in income, you completely glossed over the critical fact that CAF income is actually down 1.0% year over year. The core internal engine is losing horsepower.
The slight income drop is completely offset by the underlying margin strength. CAF's total interest margin percentage actually improved by 20 basis points to a very healthy 6.7% of average auto loans outstanding. In a highly volatile, unpredictable interest rate environment, expanding your interest margin to 6.7% shows incredibly sophisticated underwriting and strong structural control over their financing spread. The engine is tuned precisely. A 6.7% margin is a stabilizing element, I will definitely admit that. It proves they know how to price risk. But a 1.0% drop in overall net income means the portfolio growth isn't actually outpacing the rising cost of their own funds or their mandatory provision for credit losses. The CAF engine isn't stalling entirely yet, but it is definitively plateauing. It is simply not generating the excess financial torque needed to pull the rest of the struggling retail business out of its massive margin compression ditch.
That brings us to the anvil. Section 6, the final iron verdict. We have meticulously examined the data. Here is the definitive institutional view. CarMax is navigating a brutally difficult, high-interest used car market with commendable, industry-leading scale. Generating $8 billion in quarterly revenue, successfully growing total unit volume by 3.3%, and structurally reducing SG&A by 3.7% proves the underlying business model has extreme resilience. The $500 million term loan effectively secures their long-term liquidity, and the robust 6.7% CAF interest margin proves their internal financing engine is fully intact and profitable. This is a solid foundation forged in steel that is currently weathering a severe cyclical storm. They are positioned to dominate when the cycle finally turns. And here is the raw, cold reality for the retail investor. That foundation is riddled with massive structural cracks that are expanding under pressure every single day. Net earnings plunged 11.8%. Crucial comparable store sales are negative, meaning the core physical business is actually shrinking. They are bleeding $230 in profit on every single retail car they sell just to maintain the illusion of volume. And they are moving $500 million debt loads around, from revolvers to term loans, just to manage their credit lines, while sitting on a staggering $15.5 billion in total notes payable. This isn't a company forging organic growth. This is a highly leveraged value trap desperately slashing its own operational costs to mask a rapidly melting core business model.
The data is laid out on the table. The stress test is complete. Now, the final investment decision rests squarely in your hands.
Exactly. The market doesn't care about your feelings, and neither do we. Look at the numbers, assess the structural integrity for yourself, and make your move. Will you buy the dip, trusting management's shiny blueprint? Or will you walk away from the wreckage before the floor completely caves in? Let us know in the comments. This is Iron Financial. We'll see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.